Good evening, friends. Last session we have discussed about maintenance of books of account under Income Tax Act. Basically, I covered section 62 of Income Tax Act 2025. Earlier it was 44AA of Income Tax Act 1961, but now it comes under section 62 of Income Tax Act 2025. Today we will go into methods of accounting under Income Tax Act 2025. Basically, methods of accounting was covered under section 145 of Income Tax Act 1961. Then there was method of valuation of inventory under 145A. But now they bring it under 276 for methods of accounting under Income Tax Act 2025. There is 277 which covers methods of valuation of stock, and 277 it relates to recognition of revenue in three special cases. Now, what are all these things we are going to discuss in today's session? It is very important to understand why there is a need of method of accounting under Income Tax Act, where people are maintaining books of accounting under generally accepted accounting principles of India or as per the guides given by Institute of Chartered Accountants of India. There are several accounting standards which are applicable to non-corporate assets, and there is Ind AS which is applicable to corporate assets. Now, as per those accounting standards, normally assets are maintaining the books of account, but still Income Tax Act suggests methods of accounting under 276 of Income Tax Act 2025. Now let me go to the provisions of 276, and thereafter we'll discuss about the critical issues relating to this. See, I am just referring the Bare Act 2025. It is an awareness session because Income Tax Act 2025 is applicable from 1st April 2025. So it is essential for those who are students of income tax, maybe BCom, MCom, or students of ICAI, Institute of Cost and Management Accountants of India, ICSI, or personals who are involved in providing consulting services of Income Tax Act. So I am just briefing it out. If you go to 276, then there are three subsections under 276. 276 subsection 1, 276 subsection 2, and 276 subsection 3. Now what 276 subsection 1 says, I am just reading the act or the section, thereafter we will interpret. 276 subsection 1 says, income chargeable under the head profit and gains of business or profession or income from other sources shall, subject to provisions of subsection 2, be computed as per either cash or mercantile system of accounting regularly employed by the SSC. Okay. Now, this is 276 subsection 1. First I will cover this subsection, thereafter we will go to 276 subsection 2. If you minorly read the section, then point 1, it is applicable in case of persons carrying on profit and gains of business or profession or income from other sources. As you know, there are 5 heads of income under Income Tax Act. Salary is taxable either a due or accrual basis, whichever is earlier. Income under the head house property, which is taxable as per the provisions given under income from house property. We will go to that subsequently. Then there is business profession, then there is capital gain, then there is other sources. So this section 276 is applicable only to the head income under the head business profession and income from other sources. It is not applicable to income under the head salary, income under the head house property, and income under the head capital gains. So income under these 3 heads, salary, house property, and capital gain, should be calculated as per the provisions of the Income Tax Act as has been given under those sections. Okay, it is clear. Secondly, it talks about subject to provision of subsection 2. That means 276 subsection 1 says you will maintain the books of account for business profession or other sources under two methods, either on cash basis or mercantile basis, and it should be regularly employed. That means once you opt for cash method of accounting, then you have to regularly follow cash method of accounting. And if you are following mercantile or accrual basis of accounting, then you have to regularly follow mercantile or accrual basis of accounting. So they have suggested you two methods of accounting, either cash method of accounting or mercantile basis of accounting. So you cannot go for hybrid method of accounting. What is hybrid method of accounting? Hybrid method of accounting is a combination of cash method of accounting and mercantile basis of method of accounting. So either you will follow cash method of accounting or you will follow mercantile method of accounting. It is clear, there is no doubt regarding that. Whatever method you prefer or whatever method you select, you have to regularly follow that method, whether it is cash method or whether it is mercantile method. Now regularly follow, that means whatever method you prefer, you have to apply the method of accounting and that should be regularly followed by you. उसको आप regularly follow करना पड़ेगा. ऐसा नहीं कि इस साल आपको टैक्स कम लगेगा इसीलिए आप कैश मेथड ऑफ अकाउंटिंग फॉलो कर दोगे और अगले साल आपको टैक्स कम लगेगा मर्केंटाइल में तो आप मर्केंटाइल मेथड ऑफ अकाउंटिंग फॉलो कर दोगे. Irrespective of the fact whether your tax liability rises or falls, whatever method of accounting you followed last year, it is expected that you will follow that method of accounting in the current year, and it is also assumed that you will go on following that method of accounting in future unless and until there is a statutory requirement to follow a specific method by means of an enactment of law. Okay, so it is clear. But this section 276 subsection 1 is subject to 276 subsection 2. Now let me go to 276 subsection 2, what it says as per the law. 276 subsection 2 says that the central government may notify income computation and disclosure standards to be followed by any class of assesses or in respect of any class of income. That means central government is empowered to notify ICDS, income computation and disclosure standard. Under the old law, they have already notified 10 income computation and disclosure standards. I am not going into detail of those, but they are related to disclosure of accounting policies, what accounting policies you are following, that you have to. So there is income computation and disclosure standards for construction contract, there is income computation and disclosure standards for inventory, there is income computation and disclosure standards for provisions, contingent assets and contingent liabilities. Okay, so there are 10 ICDS 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, there are 10 income computation and disclosure standards presently available. Now you have to follow those income computation and disclosure standards while preparing the books of accounting. Okay, so you have to compulsorily follow the ICDS. AS is not applicable for income tax if there is a specific ICDS. Point 1. Point 2, you must remember that ICDS is applicable when you are following mercantile basis of accounting. Why? Because if you are following cash basis of accounting, when you receive the cash, you recognize it as income. When you pay the cash, you recognize it as an expenses. So why there is a need to go for ICDS? For example, construction contract, if you are following cash method of accounting, when you receive, you recognize. When you do not receive, you do not recognize. When you pay, you recognize the expenses, like this. But if you are following mercantile basis of accounting, then you have to follow percentage completion method. That means irrespective of the fact that how much money you have received, आपको कितना पैसा मिला, irrespective of that fact, on the basis of percentage of completion of the service rendered to your customer, you have to recognize the revenue. For example, you have entered into a contract to construct a house for rupees 50 lakhs. Now, suppose 70% of the construction is complete. So, 35 lakhs is equal to your revenue. Suppose the customer has paid only 30 lakhs, then under cash basis, you will recognize 30 lakh as revenue. But under mercantile basis, percentage completion method will be applied and 35 lakh will be recognized as revenue and profit will be calculated on that, and balance 5 lakh will be recognized as receivable. मुझे पाना है उससे, I have not yet received, but you will calculate the profit on 35 lakhs. This is the difference. I am not going into detail of the income computation and disclosure standards. That I will cover in my specialized sessions. Please like and subscribe my YouTube channel, because very soon I am going to start in-depth sessions on income tax, GST, accounting standards, Ind AS, and I will go into various judicial pronouncements given by Honorable Supreme Court, High Court, tribunals, for those who have interest in these fields. That will be completely private and it will be allowed only to those who have subscribed my channel. But this is a generalized awareness session. Okay, here our purpose is to understand the basic applicability of the income tax. So what I say, 276 subsection 1 relates to method, matlab you can follow cash basis of accounting or mercantile basis of accounting, point 1. Point 2, once you prefer or select a method, you have to regularly follow that, point 2. Point 3 is that it is subject to section 276(2), which says that you have to follow the ICDS notified by central government. ICDS is applicable when mercantile basis of accounting is followed. Now you clear? And most importantly, this method of accounting is applicable to income under the head business profession and income under other sources. Clear? Now let us go to 276 subsection 3. It is very important section. What it says, let me first read the section, then we will analyze and interpret. Okay, I will suggest, if you have interest in, then go to CA. CA matlab conceptual and analytical. Have hold over the fundamentals and concepts and then analyze it. Now what 276 subsection 3 says, let me read it. The assessing officer may make an assessment in the manner provided in section 271 where, one, very important, he is not satisfied about the correctness or completeness of the accounts of the SSC, or 2, the method of accounting provided in subsection 1 has not been regularly followed by the SSC, or point 3, income has not been computed as per the standards notified under subsection 2. So here the question is, what is section 271? When the assessing officer will carry an assessment, if any of these three conditions is satisfied, then he can make assessment under section 271. Now what is 271? Income Tax Act 2025. Now what is 271? 271 relates to best judgment assessment. That means he will not take into consideration your books of account. He will not take into consideration your documents. Whatever documents is available to him, whatever books of account is available with him, he will apply his own thought process and he will make the assessment. That means whatever profit you have identified or disclosed, he may not take that profit into consideration. He will apply his own thought process and he will find out what should be your profit, and on that he will impose the टैक्स लायबिलिटी, उसके ऊपर वो टैक्स लायबिलिटी इंपोज कर देंगे. सो यहाँ पे ये कहा गया है, अंडर व्हाट सर्कमस्टांसेस द असेसिंग ऑफिसर में ऑप्ट फॉर बेस्ट जजमेंट असेसमेंट अंडर सेक्शन 271.1. यू आर नॉट फॉलोइंग रेगुलरली द मेथड ऑफ अकाउंटिंग. मतलब कभी क्यास कभी मर्केंटाइल. Point 2 is again very important. Satisfied, he is not satisfied about the correctness and completeness. That means you do not have sufficient document to support or evidence to support your books of account. This is related to completeness. Correctness means you are not following the normalized principles for calculating the profit. So there is a question about the correctness. You are not disclosing the sales. You have shown excessive purchases or excessive expenses, and you are not in a position to prove that you are right. Okay, so in that cases, correctness or completeness, and you are not following the methods of accounts regularly. And point 3 is that you have not followed ICDS. मतलब even if you are following the mercantile basis of accounting, you have not adopted income computation and disclosure standards. So non-acceptance of or non-following of income computation and disclosure standards may lead to best judgment assessment. So best judgment assessment under section 271 of Income Tax Act 2025 will be applied when assessing officer is not satisfied with the correctness and completeness of the accounting. Point 2, when you are not regularly following the methods of accounting. And point 3, when you have avoided the ICDS, income computation and disclosure standards. Under these 3 cases, best judgment assessment BJA will be applied under section 271. Assessing officer will apply his own thought process to find out the profit and tax liability. Clear? This is all about 276. Now let us go to 277, which talks about methods of valuation of inventory. यहाँ पे there are 277.1, 277.2, 3, 4 and 5. Now you just have to go to 277.1 because I am giving a generalized view. I am not going to specific views. Now what 277.1 says कि while calculating the inventory, whatever tax, duty, cess and fee you have paid, see what they have given. The valuation of inventory shall be made at lower of actual cost or net realizable value computed as per the income computation and disclosure standards notified under section 276.2. So inventory will be valued at cost or net realizable value, whichever is less. Khatam. Okay, suppose you have purchased at 1 lakh, but now its market price is 90,000. So inventory will be valued at 1 lakh on 90,000, whichever is less. That means you will recognize the inventory at rupees 90,000. Now what is the cost of the inventory? For that they have gone to 276.1 clause 2. 277 subsection 1 clause 2. The valuation of purchase and sale of goods or services and valuation of inventory shall be adjusted to include any tax, duty, cess or fee by whatever name called actually paid or incurred by SSE to bring the goods or services to the place of its location and conditions as on the date of valuation. That means to bring the inventory to its current position, whatever tax, duty, cess and fee you have paid, those should form part of the cost of inventory. That means they are talking about inclusive method. Even if you are going to take GST input credit, recognize purchases at cost plus GST, recognize sale at cost plus GST, okay, and whatever excess tax or GST you are paying, okay, over input credit, that will be recognized as expenses naturally. Okay, so inclusive method they are talking, whatever tax, duty, cess and fee you have paid to bring the inventory to its current position. That means whatever tax, duty, cess or fee you are paying after bringing the inventory to its current position, that means the position at which the inventories are there as on the date of valuation, after that whatever tax, duty, cess or fee you are paying, that will not form part of the cost of the inventory. Next, they talk about securities. Suppose you are a dealer of shares, debentures, etc. and etc. In that case, two issues you have to take into consideration. If these are listed in recognized stock exchange and their values are identified, then cost or market value, whichever is less. If they are not listed, then you have to take the price at which they have been acquired, that means the cost. Okay, these are the things that you have to keep in your mind. That's all. That means recognized stock exchange में listed है and price is available in the market, then cost or market value whichever is less. But if it is not listed in recognized stock exchange, or even if it is recognized stock exchange, but its market price is not identifiable, then you take the securities at cost price. That is well. Okay, so inventory you just keep in your mind. Securities matlab shares, debentures, normally cost or market value whichever is less. But if not listed in recognized stock exchange, you have to take it at cost because market price is not available. That means you cannot say that I will make a fair valuation of the securities by a registered valuer, and if the fair valuation is less, then I will show it at less. It is not possible. It is only mark to market. That means if market price is available, cost or market price whichever is less. That means if it is listed in recognized stock exchange, else it will be recognized as cost. Okay, that is final. Second thing is for other inventories, cost or market value is whichever is less, the method of valuation of inventory. But here whether tax, duty, cess, fee, whether inclusive method, exclusive method, you go by inclusive method. Purchases plus tax, duty, cess, fees, sales plus tax, duty, cess, fees, sales, credit, purchase, debit. That's all. Okay, this is the method you have to follow to find out the methods of valuation of inventory. So I have covered 276 and 277. Now it is 278, taxability of short-term income. Here they are talking about three types of income. Okay, what are these three types of income? Let me talk about it. One is your compensation. Okay, second is your increase in revenue due to escalation clause in contract, works contract. Since you are following percentage completion method, suppose there is an escalation clause, so whether escalated price I will consider or not. Third, it is related to what I call as government subsidy or incentives receivable. Okay, so three cases. One is compensation on acquisition, compulsory acquisition, compensation or enhanced compensation on compulsory acquisition of any of your property. Second, you relates to what I talked already in case of works contract. If there is a escalation clause, whether you will consider that escalation amount or not. And third, it is related to subsidy or incentives. Now first about compensation or enhanced compensation and interest on that. Here what it says, I am directly going to that, then I will interpret it. Any interest received by an SSC on any compensation or enhanced compensation shall be deemed to be the income of the tax year in which it is received, irrespective of anything to the contrary contained in section 276. So they are basically talking about interest received on compensation or enhanced compensation. It is taxable in the year in which it is received. Over. No further discussion. Interest on compensation taxable on the basis of receipt, but compensation, enhanced compensation is taxable as per the method of accounting followed by you. That means either if it is a business income, either cash basis or mercantile basis. Now when it is, because you will say that's a compensation capital receipt, so it will be taxable under capital gain. Here I will say that suppose you are a real estate or builder. Okay, so in that case land is your inventory. So if land is compulsorily acquired by government, in that case when it is taxable, compensation is taxable on the basis of method of accounting followed by you. ICDS construction contract, you have to compulsorily follow percentage completion method. But interest on compensation 277 will be applied, and it is taxable in the tax year in which it is received. Tax year means now the definition is changed. There is no previous or assessment year. There is the tax year, that means the year in which income is received and taxable. Clear? No doubt. Now let me come to 278.2. Now what 278.2 says? 276 is your method of accounting. 277 valuation of inventory, and now we are discussing about specialized income. 278. Now 278.2 says, suppose in the works contract there is an escalation clause. Now whether I will take into consideration the escalated value. Here it says, any claim for escalation of price in a contract or export incentive shall be deemed to be the income of the tax year in which there is reasonable certainty of its realization is achieved. For example, escalation clause hai, but both parties by terms and conditions by written agreement must come into a consideration that the escalation clause will be applied and amount will be paid. So escalation clause mein revenue will be recognized only if there is reasonable certainty, 100% certainty through evidence or through proof that the excess amount will be received by you. Then only it will be taxable. So long as reasonable certainty is not achieved, the escalation clause money will not be taken as revenue. But once reasonable certainty is there, it will be taxable. Over? Clear? Escalation clause. Then I am going to the third part. It talks about the income referred to in section 2 subsection 49 clause W shall be treated as the income of the tax year in which it is received, if not charged to income tax in any earlier tax year. Now, section 2 is related to definition. 249 talks about income under the head business professions or some income, and clause W, 249W relates to your what? Subsidy receivable from government, grants receivable from government. Now, these subsidies and grants will be taxable in the year in which they are received. That means they are taxable on receipt basis. That means on cash basis, receipt basis, irrespective of method of accounting you are following. So 278 talks about three types of income on which cash basis of accounting will be normally applied. One is interest on compensation and enhanced compensation will be taxable in the year in which it is received. Point 2, escalation clause related income will be taxable in the year in which there is reasonable certainty, irrespective of the fact whether you received or not received. When there is reasonable certainty that it will be received, in that year it will be taxable. And third relates to government grants, subsidies, etc. They will be taxable in the year of receipt. So whatever doubt you have, you can contact me to my WhatsApp number 94374333425. Okay. Now I will request you to subscribe my YouTube channel, okay, Wake Up Bharat channel, and I am giving all these as awareness programs, and for advanced studies you can contact me so that we will have discussion. Thank you very much for your patience hearing. God bless you all, and I hope you will definitely learn from these sessions and will utilize it in your day-to-day business life. Thank you, friends.